Good morning.
Is the camera on? Oh, I guess I got to turn it on. It's on. Okay. Good morning. My name is John Adler. I'm the mayor's representative, and I am facilitating this inaugural meeting of the Common, like that, huh? Of the Common Investment meeting for the 5 New York City retirement systems. The first step today is we have to convene each of the 5 boards separately. So we're going to start with NYSERS. So I'd ask Diane to call the roll for NYSERS.
Okay, Chair.
Here.
Controller's Office.
Here.
Public Advocate's Office.
Here.
Borough President Manhattan.
Here.
Borough President Brooklyn.
Present.
Borough President Queens. Borough President Staten Island.
Present.
Borough President Bronx.
Present.
International Brotherhood of Teamsters. Transport Workers Union.
Here.
Council 37.
Thank you, Diane. And for the teachers' retirement system, Patricia?
Joe Nadler,
Present.
Charlotte Thayer, here. Thomas Brown,
Here.
David Kubanski,
Here.
Sandra Moore, Susanna Vickers. Here.
Thank you. For the police pension fund, Nicole? Or someone else doing it? Kevin?
No, I'll do it, John.
Okay, Kevin.
I apologize, we do things a little differently. I'm going to have the trustees introduce themselves for the
Okay.
record.
Joe Alejandro, designee for, should I do that now? Patrick Lynch and John Puglisi.
Dan Torelli, designee for Mubarak Abdul-Jabbar. Joe Rayo, DBA.
Michael Pell. Michael Palladino, DEA.
Okay, Rosemary Giselles, designee for Police Commissioner Bratton.
Bob Ganley, SBA, designee for Ed Mullins, and proxy for Lou Turco from the LBA.
Tony Rodriguez, designee for Finance Commissioner, Jackie Huck.
John Adler, designee for Mayor de Blasio.
Okay, thank you. We have a quorum.
Okay, thank you. Next is the fire. Doug?
Yeah. John Adler,
Present.
Suzanne Vickers.
Here.
Antonio Rodriguez.
Here.
Steve Cassidy.
Jim Slevin, proxy, Steve Cassidy.
James Levin.
Here.
Eddie Brown.
Vince Speciale, proxy, Eddie Brown.
John Kelly.
Vince Speciale, sitting for John Kelly.
James McGowan.
Here.
John Farina.
Here.
Paul Farrell.
Here.
Tom Phelan.
Tom Fallon is here. He's checking in outside.
And me, Doug White. We have a quorum.
You want to just state for the record who you are and
Elisa Velasquez, Queensboro President's Office
for NYSERS?
for NYSERS.
Okay. And then we have Burrs.
Rick Hedeman, designee for Executive Director Harvey Gordon.
Milagros Rodriguez, trustee of Burrs, employee trustee.
Ben Schuldner, first trustee.
Isaac Carmignani, Burrs trustee.
Okay, is that it for Burrs? Thank you very much.
Yes.
Okay, so we have each of the boards now convened, and I just want to ask Andy Dowling of New York Law School to welcome us here on behalf of the law school.
Thank you very much, John. I was walking on the street this morning. I didn't know I'd be here, giving some words, but Anthony cannot be here. He's at grand jury duty, Dean Crowell. But he's very thrilled to be hosting the first ever kickoff meeting of all the boards and under the leadership of Scott Stringer, the Controller's Office, and his staff and their expertise. So he'd like to welcome everyone here, and he's very thrilled that it enhances the reputation of the city of New York. And he wants to thank you very much. Thanks again.
Thank you, Andy. Okay, I'd like to acknowledge Controller Stringer and ask him to address the group. Okay. Yeah, I'd like to acknowledge that Public Advocate Tish James is here as well. Good morning.
I'll be very brief because I know you have a lot of work to do today, but I do want to thank John, and I want to thank the mayor and all the trustees for getting this done and this important meeting change. I do believe that the Common Investment Meeting is going to enable us as trustees to be effective and efficient guardians of the retirement security of 715,000 members of this system and their beneficiaries. So I just want to thank each and every one of you, the trustees who are the guardians of our pension system. And I want to just thank the Comptroller's Office, the Mayor's Office, and all of you. So I wish everyone a happy and healthy holiday season, and I look forward to getting about the business of the presentations today. So thank you all very, very much. It means a lot to me, and I think it means a lot to the city of New York and the people we represent.
Thank you, Mr. Controller. Okay, and with that, I think we're going to turn it over to Scott Evans, Chief Investment Officer, for the asset class update.
Thank you very much, Mr. Facilitator. I just got to start off by saying thank you to each and every trustee for participating in this common investment meeting. This is an historic moment for BAM. And for those of us at BAM, in the Mayor's Office of Pension Investments, for the consultants who have come to 54 meetings a year, to be in a forum where we'll be coming 6 times is wonderful. And so thank you on behalf of the entire BAM staff. I am going to go through the normal third quarter presentation that I would go through with each of the 5 boards. You have your individual board packets in front of you. You won't need them today. I have slides that are going to cover all 5 boards, and there'll be page numbers on some of them with specific reference to your board books in case you want to look at some of the details, because these are high-level slides. And I'll point that out when we get to it. Just for those scoring at home, we have a color scheme. Teachers is yellow, Nicers is gold, Police is blue, Fire is red, and BRRRR is green. And so those colors will be consistent in all the slides, so you know which of the systems we're referring to. So as you recall, the third quarter, which ended in September and seems like a long time ago now, was a messy quarter. It was an ugly quarter. Everything was down. And it was down for a couple of reasons. There were things going on in China, in Europe, with the oil price, and with the behavior of the Federal Reserve and the European Central Bank that caused people concern. They caused everybody to worry, everybody to look as if the glass was half empty. It started in China at the beginning of the summer, if you can remember. We were talking about the sudden decline in the Shanghai index, local index in China. There was some consternation about the depths that China was falling to. We said at the time, and prognosticators said at the time, not to worry. China has an immature speculative market, and there's nothing other than the normal blow-off. And as things went on, people became a little concerned. Some of the economic numbers coming out of China were soft. And people began to worry, but they said, China has things under control. China can manage its way out of anything. They have different rules than the rest of us. Not to fear, they're still going to hit their targeted GDP. Then the oil price, began to plummet. And you can see it was already on its way down from 88 about a year ago and had fought back, but then had a precipitous decline. This is the fourth quarter here. A precipitous decline, I think it's some 30% during the course of the quarter. China, as you know, is one of the large importers of oil in the world. People began to worry about whether they were effectively making the transition from a producer economy to a consumer economy, which we all know and we've talked about for many quarters is a necessary transition for the economy that is representative of the marginal growth in the world economy. And it was kind of the usual consternation until China did something unexpected. They let their currency drop. And you can see it right here. I think it's August 26th. They let their currency drop 3%. They'd been managing it at a pretty steady rate for a long period of time, gradually allowing it to weaken and then holding it steady, and then purposefully let it decline. That was seen as a sort of shameless attempt to boost exports. They must be desperate to take this kind of move, and people began to really worry. You can see this in the S&P Volatility Index, which all 5 boards are familiar with. We look at it every quarter. It's the angst in the overall market in the United States. This is not China now. This is the United States. And while we were at pretty modest levels, 20 is about average for a very, very long period of time. The volatility index suddenly shot up to 40, which we haven't seen since the global financial crisis. The risk trade was on. People were nervous, and the markets started to go down. You can see this through a different angle by looking at what people were willing to pay for a dollar of earnings. The earnings are in orange. You can see almost flat. This is the same 4-quarter period. This last bar, I'm going to make sure I don't put people's eyes out with this thing. The last bar is the last quarter here. You can see earnings expectations for the S&P 500 absolutely flat during this period of time. But the price that people were willing to pay plummeted during that period of time. Same time that volatility is happening in the marketplace. There's a longer-term look at the same phenomena, global financial crisis, and the build back, and then the plummet that we just saw. If we look at bonds, we see the same kind of behavior. And we were talking about the fact that, and we've talked for the last couple of months, people weren't really paying an adequate price for risk in the bond market. When we lent money to investment-grade borrowers, getting like 100 basis points over the treasuries, as you can see here. It's moving up slightly, and then during the course of the quarter, and you could see some in anticipation of that, spreads widen back to at 150 basis point, more of the spread that we're used to seeing. I'll show you the same chart. This is investment grade. You can see how high it is on this scale. You can barely see it on this scale. This is investment grade. I'm sorry, high yield in orange. High yield bonds really beginning to tumble, and yield spreads really beginning to widen. It's great news if you're putting new money to work because you're getting paid an extra premium. It's bad news if you own the bonds already. So what would you expect in this environment? That as you take more risk, you're going to be penalized on the return side. So let's have a look at how that worked out in the various corners of the public markets that we invest in the New York City pension funds. What I have here is a look at the public asset classes. And they're arranged in order of risk. So we have the riskiest up on the top. You can see this because I put the expected return 4 years ago when we did the last asset allocation on the right. Emerging equities were expected to earn 9%, all the way down to U.S. government bonds expected to earn 4%. So in a normal environment, the asset classes on the top would have the highest return. The asset classes on the bottom would have the lowest return. What we saw in the third quarter is just the opposite. The best returning was the least risky, the U.S. government bonds at 3%. The worst returning was the most risky, emerging equities at minus 18%. Minus 18% for a 3-month time period. This is a bad quarter. This is stress. And although it's not fun to live with, for us as trustees, with a very, very, you're trustees, I'm an investment advisor, for you as trustees, and for me as the Bureau of Asset Management, we have a long lens. We're built to deal with volatility. But a quarter like this gives us a sense of what does the stress do to our portfolio? How well do we hold up in a period where suddenly the short-term investors around us are panicking. So let's have a look at how the pension funds themselves did. Now here you can log into your board books if you want. This is the State Street Performance Book. Teachers, Police and Fire, page 15. BRRS and NYSERS, page 14. Only if you want to. You can see everything in these slides. But if you want to look at the details, that's how you log in. And we'll use the same rubric with all of our slides today. I won't mention it every time, but you'll see it up at the top of the slide. So here I have the funds, the various systems ranked in order of the riskiness of their portfolios. And I use a simple statistic, which is what percentage of the portfolio's allocation is in public equities. So you can see that BRRS has the riskiest portfolio. They're structured, they have less alternatives than everyone else, and they have the most public equities. So they're the riskiest. Without any information, you would expect them to go down the most. And the least risky, NYSERS and Fire at 49%, you would expect them to go down the least. And that's exactly what happened. NYSERS was down 5.9, Teachers 4.9, Police 4.6, NYSERS 4.6, and Fire 4.3. By comparison, the median manager in the Tux universe, so that is the peer group of pension funds and other large institutional portfolios, down 4.5%. So everyone was similarly affected. BRRS a little more so because they take a little bit more risk. If you look over the long period of time, you can see that the returns across all 5 systems are almost on top of each other, 8.2, 8.3%, and the median Tux universe up 8.1%. So we have 5 portfolios that are giving you the kind of returns that are experienced by the median large institutional fund over long periods of time. And the short-term sensitivity you can see there. So let's drill in a little bit more. First, I want to, you see an asset allocation slide every time. I've changed it a little bit this time, and I want to slow down and spend just a little bit of time on it. This is the one where I tell you where the asset allocation is relative to policy, whether you're underweight or overweight. And so we've changed it up a little bit. We just, sorry about my back, people in the front. This gray bar here gives you the allowed range. So for BRRS, they can be plus or minus 4% of target. At 39.4% domestic equity, they're a little above target. And you can see the other systems also have most of their assets in domestic equity. They were just a little under target, mostly on target. The international equities were under target, and that's as you'd expect because the international equities were down more than the rest of the portfolio during the time. So we're constantly rebalancing, and after the end of September, we rebalanced, and those of you who've seen October numbers already know that our October numbers were in balance across equities. Our policy, our goal is to stay on target across all the equity asset classes, domestic, international, emerging, hedge funds, private equity, and real assets. We want this to be flat and right on zero over time. In fixed income, as you know, we have a little different structure. Because of the abnormally low level of interest rates, our normally long exposure to long-term bonds has been offset by a increased exposure to short-term bonds. This is short-term bonds, this is long-term bonds. When you put both of these together, you get average interest rate sensitivity similar to the Barclays Aggregate Index. And we feel this is appropriate during this period of time when we have such low interest rates and the risk is that they'll rise. In fact, the Federal Reserve is expected today to raise rates about 0.25%. Now let's talk about the returns in the portfolios. I'm now going to drill into the returns so we can understand where they came from, how we did versus benchmark, both totally, and then I'll break down and go through the various asset classes. Same thing I do each and every quarter. The charts are a little different. Remember, Teachers is yellow, NYSERS is gold, Police is blue, Fire is red, and BRRS is green. This is your benchmarks. If we were right on benchmark, this is what we do. Down about 4.5% for the first four funds, and then BRRRR's down about 6%. This is the portfolios. They look very much like the benchmark. And so you can see that our asset allocation is driving most of the performance. This, on the right, is the difference between the portfolio and the benchmark. It's the excess return. When this number is above zero, we're adding value relative to the benchmark. When it's below zero, we're under benchmark. And as you can see, we're ever so slightly below benchmark, so much so that at a 550 to 850 scale, I've got to blow it up so that you can see what's going on. And that's what I do here. We're plus or minus 200 here. These are the four systems. You can't see teachers because teachers was right on the benchmark. So their performance was right on the benchmark. And the other four systems were slightly under, all of them well under 50 basis points. We want to see, was this coming from the fact that we were different from the long-term asset allocation, or is it coming from the manager performance versus benchmark? This first group is the asset allocation. As you can see, not much impact, slightly positive. If you drill into your books, you can see that the slightly positive was coming from the fact that we were overweight short-term bonds, shown as cash in your book. As you know, it's about 2-year bonds. They perform well in this environment. They were flat to up a little bit when the market was down. Most of the negative performance, and again, very modest negative performance, is coming from manager value added. And that's what we spend all our time thinking about. And for the rest of my presentation, I'm going to drill into just the manager value added. I'm back to the 550 to 850 scale. So I'm back to this scale here. Okay. And we're going to look at the third quarter on the total portfolio, which you just looked at before. But I want to show you what we did calendar year to date and then in 2014. These numbers are all net of fees, net of all fees. As you know, last quarter we began showing everything net of fees, and you're seeing everything net of fees here. As you can see, we're still very modestly down for 2015, an improvement over the relative performance in 2014. In U.S. equities, we were slightly down in the third quarter. We have done better during the year, so the third quarter was the first time we were down, and much better than we did in 2014, but all these numbers are very modest. Developed equities, it was a tough quarter. And you can see in the 50 to 70 basis point for most systems, and then BRRRR's was down 300 basis points. So just a comment about this and a comment about the volatility of BRRRR's. As the BRRRR's trustees know, they like to have just one or two managers in an asset class. And so their performance is going to be more volatile. Not necessarily better, not necessarily worse, but more volatile over time. So as we look at short-term time periods, we would expect BRRRR's to be volatile. And when we look at long-term time periods, in fact, BRRRR's numbers are quite strong on an absolute and relative basis. In emerging equities, despite the fact that this was the worst sector in the market, we held our own. A little bit down in some systems, and we have fire and police were actually up relative to their emerging equity benchmark. Part of this is, as you know, is that fire and police have no special rules in emerging equities, and teachers and NYSERS have special rules about what countries they'll invest in. So they're not totally compatible. Their benchmarks and portfolios are not totally compatible with one another, but they're similar. And we're a little underwater, a little bit more than 50 basis points for the year. You can see 2014, here's the volatility of BRRRR's. They had a lights-out performance over 550 basis points in 2014 because of a specific manager. That specific manager was owned by all the systems, but BRRRR's only had that manager in their portfolio, and that's why they're more volatile. Core fixed income had a tough quarter, a little bit more than 50 basis points, but that's a tough quarter for fixed income that stays very close to the range. It had to do with the fact that we were sort of structurally underweight long-term government bonds and overweight credit bonds in the portfolio. Both Robert Fang will go through this, and Wesley Pulisic in opportunistic fixed income to some extent, to go through this in detail. But that was the reason that we were underwater during the third quarter. In tips, you can't even see it in the third quarter. We're right on the line. It's because 75% of the tips portfolio is passive. So you wouldn't expect tips to see very volatile numbers. ETA, economically targeted investments. Very strong numbers here. Very strong numbers. We'd love to see these numbers all the time and across asset classes. Let's not forget that this is a very small allocation. You can see the size of the allocation over here. 0.9% for teachers, 1.3% for NICERs, and so on. We'd like to be 2%. That's our policy. And we make every loan that qualifies in this space. There's just not enough volume. As Brian will tell you when he talks about ETA in the future, there is some built-in interest rate sensitivity in this that benefits from an environment where government rates are going down. And so you would expect ETI to do well in an environment like this. These are very safe bonds. They're most of them guaranteed by either the state government or the federal government. Bank loans, despite the fact that yields were rising, more than kept pace with their benchmark. They were up in the quarter, they're up year to date, and they were up last year. So strong performance. Again, modest, less than 150 basis points, but strong performance across the systems, across bank loans. High yield. Terrible, terrible absolute quarter for high yield, as I discussed. But relative to their benchmark, they did pretty well. They did not go down as much as the high yield index. And they were strong, particularly with FIRE, strong relative to the benchmark, and some of them were almost flat. And last year was decent. 2014 was slightly down. Convertible bonds also had a strong performance. We have some managers in the portfolio that do well in markets where defensive players do better than others. And they performed according to what we would expect during the third quarter, up over 200 basis points across the systems that are using them. Opportunistic fixed income. This is a terrible looking chart. Terrible looking. Until you understand what you're looking at. With opportunistic fixed income, as you all know, our benchmark is a very long-term benchmark, and it's an absolute benchmark. It's simply, are we above or below 10%? Well, in an environment where bonds are going straight down, particularly risky bonds, we're going to be well below 10%. So while it's the correct long-term benchmark, short-term you need something else. And Wesley will actually show you the performance relative to the high-yield index as we look at high-yield bonds and relative to other parts of the market. You'll see that when you look at those secondary benchmarks, opportunistic fixed income actually held in pretty well and performed well. But this is our long-term benchmark, and we underperformed it as we would expect to in this type of environment. Hedge funds. Now, not every system participates in hedge funds, but those that did have experienced good results, both in the quarter, in 2014. 2015, you have to break it out a little bit. We have the direct hedge funds. That's the principal thing that we do now. We also had a fund-of-funds group and still have them. And Neil can get into this in the breakout. The direct fund was above benchmark year to date. The fund-of-funds group a little below benchmark. And net, that pulled us down slightly. But we are more than keeping pace with our benchmark. The hedge fund benchmark moves up and down at different times in the equity market, and we're hanging in there with pretty decent results in an environment that everybody worries about hedge funds. I mean, as you know, and this is after the third quarter, we're having high-yield bond funds going out of business as they suddenly run into air pockets of illiquidity. And so we want to watch these risky asset classes very carefully, but we did well during the third quarter. Infrastructure. This chart looks great, but I'm going to make the same sort of cautionary statements that I did about opportunistic fixed income that look terrible. First of all, for infrastructure, private equity, and real estate that I'm going to talk about, you're looking at a different time period. As you all know, because of the reporting delays in the private asset classes, This is actually the June quarter that we're looking at. And these are time-weighted returns in an asset class that lends itself to internal rate of returns. And, we've been over this before. I'll just say quickly, since we're in public session, time-weighted returns are appropriate for asset classes where we decide to give money to managers. And time-weighted return takes out the effects of when we give and when we take the money from them. And so it takes that out of the record. But with managers who decide when they're going to call down our commitments, we want to look at internal rate of return or dollar-weighted rate of return. Now, we can't do that when we're looking at the total portfolio because the total portfolio by conventions is looked at a time-weighted basis. But we have to look at the time-weighted results in private asset classes with a bit of skepticism. And I'll get at the end here to a better measure that we're looking at and that we'll be using going forward. But that being said, for the money that was pulled down by our infrastructure funds, and it was a small amount of money in a sort of starter asset class, we had great results in 2014, and 2015 has gotten off to a great start as well. So there's nothing to take away from that. It's a good result, but it's not the preferred way to measure things. Real estate, it has the same issues, but if you think about it, real estate's a very mature asset class. The money's been called down already, and it's at a consistent level, so the numbers are a little bit more representative. Real estate had mixed performance in the third quarter. Year-to-date has been positive, and 2014 was very positive. Private equity, the latest quarter, remember this is actually the second quarter results. Private equity had a very strong quarter on a time-weighted basis. Year-to-date was mostly positive. 2014 was very negative on a time-weighted basis. This is an asset class where you give a manager money, and if you're lucky, you'll get it back in 7 years. It could be 15 years. Measuring things on a quarterly basis, whether it's positive or negative, and it's a good quarter to talk about it because it's positive, not the way to look at things. As I said before, time-weighted return, not the way to look at things for private equity. We have to look at dollar-weighted return, and we got to look at it over the entire period of time that we have the money invested. The only way to do that is to look at cumulative returns. How have we done in giving managers money since we started the funds? So this is going back to 1998 for the private equity funds. So when we give them $1, we start measuring their returns, and if we want to see what we would have done with the dollar if we didn't give it to them, we measure how the dollar would have performed if we had kept it in the Russell 3000, which is the benchmark. And we do internal rate of returns or dollar-weighted returns for both. Then we calculate the cumulative returns. We take the difference, called the spread. The difference is the PME spread. PME is the public market equivalent, Russell 3000 in this case. So the difference between the two is the cumulative PE spread. That's the number, that's the bottom line for private asset classes. Now, we've calculated that in private equities, and here it is. And as you can see, when you look at the returns since the beginning of our investments in private equity and measure it correctly and look at the PME spread, in two of our funds, we're a little less than even. And what this tells you is we would have been better off leaving the money in the Russell 3000 in these two funds. We have three funds that we were better off than we would have been if we'd left the money in the Russell 3000. Both modest, both arguably about the same results as the Russell 3000. What do we expect? Would we even invest in private equity if all we got was Russell 3000 returns? No. We expect 300 basis points. That's our goal. And that's what we consider success. So until this number is above 300, we're not satisfied with the results in private equity. Alex Danier, when he talks to you this afternoon, is going to break out the private equity portfolio and tell you why, in spite of these numbers, we are comfortable that we're moving in the right direction and that the PME spreads in those managers that we have a great deal of confidence with are looking quite acceptable. But we're going to have to talk about manager by manager, and so we'll do that in executive session. That is the end of my prepared remarks. I'm happy to take any questions, comments, After this is over, we'll take tweaks in how we're doing this. This is the first day of school with the Common Investment meeting, and we are open to suggestions on how to adjust things. That'd probably be better in the coffee session, but do you have questions on the presentation?
Can I just ask people to identify themselves for the transcriber when you're asking your questions or making your comments? Thanks.
Thank you, Antonio Rodriguez. Thank you, Scott. I had a question as far as the kind of the value add section. For a couple of our asset classes, I'm using hedge funds and convertible bonds in particular. We've typically in our board books had two different benchmarks that they were measured against. Can you tell me which benchmarks we were using for hedge funds? Was it the T-bill +4 or the HFRI +1?
I think it's the HFROI +1. And what we do here is we look at the benchmark that's used when we're pulling together the composite results for the benchmark. You're right that there's secondary benchmarks in some. I was talking about opportunistic fixed income, where our primary benchmark is 10%. Our secondary benchmark is what are the other high yield funds doing. I would have loved to refer to the secondary benchmark because the results are a lot better, as Wesley will show you. But that's not what we do to build. So we use the primary benchmark here. Other questions? Hearing no questions, Mr. Facilitator, that concludes our public session of the first Common Investment meeting. Thank you very much.
Thank you, Mr. Chief Investment Officer. We're now going to ask for motions from each board to leave public session and enter executive session. Starting with NYSERS, do I hear a motion to move into executive session pursuant to Public Officers Law, Section 105, for discussions regarding specific investments and investment managers?
So moved.
Okay, is there a second? Okay. So all in favor at NYSERS of that motion to go into executive session, please say aye.
Aye.
Opposed? Okay. So we've done that. Now for teachers, I don't think I have to repeat this each time. So we're looking for the same motion to move into executive session. Is there such a motion?
So moved.
And a second?
I'm sorry, I'm going to need your name because I'm not going to know who said so moved. You're far away from me.
Dave Kazansky, so moved.
And is there a second?
Second.
Okay, moved and seconded. All in favor of the motion at teachers, please say aye.
Aye.
Opposed? Abstentions. Okay, we're done at teachers. Now let's move to police. Is there a motion to that effect to move into executive session at police?
Joe Alejandro, make motion to go into executive session.
And is there a second? Great. Moved and seconded. All in favor of the motion to go into executive session at police, please say aye.
Aye.
Opposed? Okay, so we're done at police. For fire, we're going to go into executive session. Is there such a motion?
Jim Slevin, so moved.
Is there a second?
James McGowan, second.
Okay, all in favor of the motion, please say aye.
Aye.
Opposed? Okay. We're set at fire. And then for BRRS, is there such a motion to go into executive session?
Milagros Rodriguez, so moved.
Thank you. Is there a second?
Isaac Carmignani, second.
Thank you very much. All in favor of the motion at BRRS, please say aye. And opposed? Okay, motion carries. Okay, so
Thank
we're
you, Mr.
now,
Facilitator.
we can turn the camera off. We're going to take a break for coffee, and let me just tell you where
Is the camera on or off?
on. So now, can we get a report out of TRS from executive session?
Yes. In executive session at TRS, manager presentations in the following asset classes were received and discussed: fixed income, infrastructure, private equity, and opportunistic fixed income. Consensus was reached, which will be announced at the appropriate time. We also received manager updates and in-depth performance reviews in the following asset classes: public equity, fixed income, economic development, real estate, infrastructure, private equity, and opportunistic fixed income.
Great, thank you, Susan. Okay, now I would entertain a motion from TRS to adjourn the meeting. And is there a second? Okay, all in favor of the motion to adjourn from TRS, please say aye.
Aye.
Opposed? Okay, the TRS meeting is adjourned. TRS is welcome to leave the room. Can we turn the camera off, please? We good to go? Very good. Okay, NYSERS, can we get a report out of the executive session?
Okay, the NYSERS Board of Trustees took 5 actions in executive session. One was to establish a manager's pool in the fixed income sector. 2 was to make 1 infrastructure investment. 3 to make 1 private equity investment. 4 to make 1 opportunistic fixed income investment. And 5 to make 1 hedge fund investment, the details of which will be disclosed upon execution of the contracts.
Very good, thank you. Okay, is there a motion from NYSERS to adjourn the meeting? Moved? And seconded. Okay, all in favor of adjourning the meeting at NYSERS, please say aye.
Aye.
And opposed? Okay, the motion carries. NYSERS is adjourned. You may leave the meeting. Okay, next we go to fire. Can we get a report out from fire?
In the executive session, the Fire Protection Board received updates on several asset classes and took action with respect to investments, details of which will be made public at an appropriate time.
Very good, thank you. Is there a motion to adjourn the fire? Point of order. Oh. A little noisy. Okay, hold on for 1 second. Sorry, John.
We'd just like to note for the record that the police pension fund, as well as the variable supplements funds, the trustees were provided with their quarterly reports electronically. Fire, yes.
And fire.
They have been provided electronically. We just want to note that for the record. If there's any specific questions about those, we'll be happy to take those at any time, and they'll be available publicly on the web as they normally are. So we just want to note that for the record.
Okay, so fire, a motion to adjourn would be in order. And second, moved and seconded.
Jim McGowan. John Farina.
John Farina moved it. Jim McGowan seconded it. Okay, all in favor of the motion to adjourn at fire, please say aye.
Aye.
And opposed? Abstentions? Okay, motion carries. The fire meeting is hereby adjourned. You guys can please exit quietly. Okay, police, I believe there's an item of business for the public meeting. Rosemary? Or Kevin?
Continue with that, or you want to close out the...
Oh, yeah, let me get the report out first, yeah. So report out of executive session.
In executive session, the board received updates on several asset classes and took action with respect to investments, details of which will be made public at the appropriate time.
Nice job.
Nice job.
Well, John Dorse has one announcement for the police board.
Yeah. We'd also like to note for the record that the trustees of the Police Pension Fund, as well as the appropriate VSFs, have been provided with the quarterly reports. As is customary practice, they'll be made public on the web sometime in the coming week.
Christmas bonus. Christmas bonus.
And you guys have one more item of business for the public session, I believe.
You're gonna hang out for this one, right?
I'm hanging out.
There you go. All right.
Rosemary, who's running this part?
He's got a facility.
Kevin?
I think it would be Joe.
Yeah, Rosemary?
You want me to do it? The PBA had requested a table with regards, at the last meeting, the disability meeting, there were items presented by the actuary, and I believe the Commissioner of Finance's office tabled one matter. PBA at that time was prepared to table it ourselves. However, the Commissioner of Finance has rescinded their vote and was prepared to vote on the matter. The PBA at that time, or at the time of the vote, rescinding of the vote was going to request electronically the table. There's been some going back and forth, so at this time, we officially would request that the matter be tabled until the January 13th meeting, disability meeting.
Okay.
I think that would be consistent. Yes.
No, do we need a
All
roll
in
call?
favor?
Aye.
All right, so given that, I think that the previous vote is rescinded. And, this will count.
Well, that,
Two votes. So,
There were two votes.
I like to make some comments before we conclude here.
okay,
But I don't wanna- are we-
before you comment, can I just, on the, Palladino from the DEA, on the record, in the event that the table supersedes and nullifies the vote, great. If not, I just want the record to reflect that the DEA rescinds the vote that we did electronically, that we voted prior to the knowledge that the PBA had wanted the table, had requested the table. So, in the event that some new information is gleaned as a result of the table, I'd like to be able to make an informed decision on the vote.
And before you go on, Sherry, I just have, if you don't mind, one or two questions. It's
Yep.
not complete list of questions, but then after I'm done, then I'll follow up on that. So with regards to part of your reasoning on the items presented in that resolution, that I have been informed that part of that was that it was based on experience that was utilized from the private sector. Again, I don't have all of the terminology in front of me, so we'd like some response or some of the reasoning behind it. And any other further questions that we may have as the PBA, can I have the actuaries that have been in contact with you back and forth reach out to you and your staff so that we could get a more full and informed process on this?
Sure, and thank you for bringing that up because that was something I wanted to address.
Mm-hmm.
I wanted to make the distinction that there is two parts to the mortality assumptions. One is the base table, which are the actual rates that people are dying based on age and gender. The other part of it is the mortality improvement scale, which is how fast their life expectancy is increasing. And I have not made any changes to the core rates. The base tables is what it's called. And those rates were developed based on experience from the OWN police data. It was studying the OWN police force and OWN, OWN. And so that was purely your demographics and obviously all public data. And I think the confusion here is that there is a table that's published by the Society of Actuaries called RP 2014. And again, that's a table, and those are peer rates of decrement. There's a mortality improvement scale called MP 2015 that's been published by the Society of Actuaries. And that speaks of how fast the life expectancy is improving. And the RP 2014 table is what Society of Actuaries has come out and said that is maybe not valid for public sector plans, and they're working on a table to replace that. However, like I said, that's not the table that we are using. We're using police's own data. And the mortality improvement scale that I've proposed is MP 2015, and that's based off of Social Security Administration's data. So that includes, that comprises obviously of both public and private sector data.
Okay.
And SOA has not come out and said that table is not valid for public sector.
So I appreciate that, and I'm going to have the actuaries we have reach out and get some more information, and then that way we can have a comfort level next month when we revisit the issue.
Okay. And I just want to make one more comment here. I know you guys already tabled the decision, but I do want to be on the record for saying that, I hope you guys think about this from a perspective that, that you share with me, which is, being the technical advisor, I'm sitting here telling you that, your demographic, the people, your membership are living longer. And, your duty as fiduciary should be that based on this black and white data that you should be funding your plan properly. It seems to me that the decision, I realize that, you know, we're not working with an unlimited budget here, and you do need a reference or a ballpark figure of how much this costs. These numbers have been published for a couple months already. They've been public, and, you know, we've had 3 different organizations run their own separate analysis, and they've all come up in the same ballpark range. GRS has done it, Buck has done it, and my own office has done it. So we don't know, we're not oblivious, we're not, we know the ballpark figure and we know how much it is approximately. And, you know, I can see a decision not being made if you know, maybe it's absurd and it's something that, you know, can't be funded. But however, you know, a decision shouldn't be made based on what the end number is. A decision should be made based on the fiduciary responsibilities that you guys have, that based on data that they are living longer and you need to pay those benefits out.
And I appreciate that comment too, and I would assure you, the PBA and I believe every trustee sitting on the police board, at least I can speak somewhat for the police board and the business that I've dealt with, we all proceed from the notion that we may all disagree on certain items, maybe sometimes on the fringes or whatever, but our whole goal is to make sure that the fund is properly funded. But I will say, in all fairness, in this matter, I have been given, in a very short period of time, not from you in particular, but I've been given a wide range from what the total cost is of this, from $500 million to about $2 billion. And I won't mention who mentioned $2 billion. Bob Lynn, by the way. But anyway, so the point here is that given that, I think it's only fair and proper that given the short period of time in which we've had to analyze this, and it was a very, very short window, that I'd like to just make sure that we're proceeding properly, at least from the perspective of the PBA, and that we're comfortable with all of the reasoning behind it. Not to say that your pencils aren't sharp and you know, the staff over there is not doing what they're supposed to be doing. So.
Okay, so my response would be that the number at the end of the day is going to come from one source, the official source, and that's me, because I'm going to be the one signing off on the numbers. So if you're hearing any other numbers out there, that should be confirmed with me, and I can say that for the number that you quoted and the range that you quoted is incorrect. Again, it's on the comptroller's website. This is public information. For police, it's about $100 million. And again, I'm working with the city to see if we can mitigate that, so it shouldn't be too far north of that number.
Thank you very much.
So that's number one. And number two, I forgot my number two, but I wrote some notes down, and it's not jotting my memory.
Yeah, you had that governor of Texas moment? Yeah.
Perry.
If you could repeat what Joe said, I think that could trigger my memory.
3 points.
If you could repeat what Joe said, that might be able to trigger my memory.
That when he was talking about the $500 million to $2 billion?
After that.
About the professional job that you're doing over there.
Sharp pencils.
Short pencils.
Sharp pencils.
Yeah.
Pencils, shorter races.
Shorter races, that's right.
I think I do remember what I was going to say. You said that you made a comment that the memo, the resolution, was presented in a short period of time and you didn't have time to review it. So what you should be reviewing, again, isn't the number, it's the assumption itself. You know, I'm not asking you to adopt any cost right now, any specific number right now. I'm asking you to, you know, review the mortality assumptions that we've presented to you and the data that supported that people are living longer. So it's the assumption itself that you're adopting and not the numbers. And so I would just, you know, again say that based on the short time frame, it's really reviewing a memo stating that the membership is living longer.
And I appreciate that. We will do that. Thank you very much.
Okay, is that all that you have to add for the public agenda?
That, I believe, was the only matter.
Okay,
that
so the
we
only
had
matter
covered.
left is to adjourn.
So I make a
the police
motion that
board
we
meeting.
adjourn the Police Pension Board.
Second. Okay, all in favor of the motion, please say aye.
Aye.
All opposed? Okay, the motion carries. I just have to make one more point for the record.
Oh.
You guys don't even have to listen to it. I think just the stenographer has to listen. Which is that, just to note that BRRS will report out
They've
on
left
their
the room.
executive
The
session
BRRS has left
at
the
the
room.
conclusion of their regular meeting, which is taking place later today.
Oh, okay.
Okay? And that does it. And the police are leaving the building.
The police are leaving the building now. We've had it.
Are you taking your guns?